Welcome and thank you for being here. If buying a home has ever crossed your mind, but you feel like you're not sure if you're actually ready, then you're in the right place. You see, many people spend months and even years wondering if they qualify without even speaking to a lender. They think about their credit, they think about their savings, they think about everything, and they just keep guessing, guessing, guessing. My goal here is to help remove that guesswork. By the end of this webinar, you should have a clear idea whether you're ready now to buy a home, close to ready, or if you need to have a strategic plan in place. My promise to you on this webinar is that by the end of it, you will know the 4 things lenders review to determine loan approval. I think that this is so important because so many people disqualify themselves and they don't even actually know what lenders are looking at to determine loan approval. So I wanted to create this webinar to give you that information. So again, my promise is by the end of this webinar, you will know the 4 things lenders review to determine loan approval. You'll also know the loan types, the common misconceptions, and you'll also know where you stand. If you're ready to buy right now, if you need to wait 6 months, or if you need to wait a year, you will definitely know by the time we reach the end of this webinar. One of the first things that I want to get into is the common misconceptions that people have. They use these misconceptions to talk themselves out of buying their home. Number one, you need perfect credit. I'm here to tell you, you do not need perfect credit. You don't want crappy credit, but you do not need perfect credit. 850 credit score, 750 credit score, 700, 680. Those are great credit scores. And yes, oftentimes it can help you with a better interest rate. But understand this, you do not need perfect credit to be able to buy a home. You do not have to have 20% down to buy a home. In most cases, you can buy a home for as little as 0% down, 3% down, 3.5% down of the purchase price. Buying is not years away. A lot of people think, oh, I got to wait so many years because it's going to take me 20 years to save the money I need because I need 20% down, or I got to get my credit perfect. These are common misconceptions that keep the average person from buying a home. Again, misconceptions, they're not truths. I got to tell you though, the biggest issue I see, it has nothing to do with credit or money. It's basically uncertainty. You don't have a plan. You don't know where to start. You don't know what the lenders look for. And hence the reason I created this webinar just for you. My name is Salandia Hammond, aka Sueham, and I'm a mortgage broker here to help you buy and or refinance your home. I'm a mother of 3 beautiful souls, a Gigi to an awesome grandson, a real estate investor, and a writer. I'm a creative being who loves helping people achieve financial success through buying their homes. I am a firm believer that living in your own home brings about peace, stability, and can lead to financial freedom. So let's get into it. The 4 things that lenders review to determine a loan approval. It's quite simple. They're going to look at your credit, your income, your debt to income, your assets. And in the case of a home loan, assets means any money that you have in 401k, stocks, bonds, in savings or checking, retirement account, 401k. That's what we mean by assets as it pertains to the home loan process. Now, as we go deeper into this webinar, I'm going to tell you exactly, break down each category as to what the lenders are looking for as it pertains to credit, income, debt to income, assets, and money. Credit score. Now, that's a big one, right? Everyone thinks that if I have the number that the lender wants, I'm automatically going to get my home. That is so not the case. Let me go ahead and tell you. We do have loan programs that will go down to as low as a 500 credit score that will allow you to buy a home. Do you want to buy a home with a 500 credit score? Absolutely not. Not unless you have a strategic plan to be able to refinance out of it. Because here's the thing. When you're buying a home with a 500 credit score, you're going to have to put down a lot more money. You're going to be required to have a lot more money in savings or checking. And your interest rate is typically going to be a lot higher. So understand this. It's very important when evaluating a credit that you understand lenders look for more than just a credit score, okay? They're looking at payment patterns as well. I always tell my clients, please try to go 12 months without any 30-day late payments showing up on your credit report. Why? Because lenders want to see that you are responsibly paying your debt. And so we can go 12 months without any 30-day lates on your credit reports. That shows responsibility. It shows consistency of paying your bills on time. And that goes for renting as well. Because sometimes if you don't have a lot of trade lines on your credit, we can use your rental payments as a debt to show that you have been making these payments on time. So even though most times your rental payments do not show up on your credit, and many people will say, hey, it won't affect me if I'm late, please, I ask you, make your rental payments on time for the next 12 months because it could help your approval. All right. And credit usage with your credit cards. If you can, pay them down. This is like the fastest way to improve your credit score is to pay down the balances on your credit card accounts. If you have these accounts maxed out, when the lenders look at this, they look at it as if you're living month to month, paycheck to paycheck, because the cards are maxed out. If you can, pay them down to the 10% balance or at least the 30% balance of the credit limit. All right. So again, credit score is important, but it is not the most important thing. Simply because we have programs that can go down to 500 credit score, which I do not advise that. You stick with me and I'm going to tell you what score I think you should have to be able to get a home loan. Payment is extremely important. Try to not to have any late payments in the last 12 months. Here's the second major thing that lenders are looking at to determine if you're going to be approved for your home loan. Job stability. I mean, that's common sense. What I tell people is we want to have at least 2 years of employment history. It doesn't necessarily have to be at the same job, but we do not want any more than a 30-day gap in between those 2 years. If it can be at the same job, it just builds your financial picture, makes it looks even stronger. If you are fresh out of college, just graduating, and you're just getting a job, this doesn't apply to you. We do have lenders that will loan to persons who are just just getting out of college with a degree and just starting a new job. But if you have no college and you're in the workforce, what I do recommend is to have at least 2 years of work history with no gaps in between. The longer you've been on one job, it shows stability, and that's important because lenders want to ensure that you're going to be able to pay this loan back. Our next thing that the lenders look at is debt to income. Believe it or not, this is the one thing that really kills a lot of deals. Not the credit score, not the job, it's the debt to income. A lot of people have more debt than they have income. Debt to income, also known as DTI, is basically how much you owe in debt versus how much you make in income. And if you can see on the screen here, we have an illustration: monthly debt $1,500 divided by your monthly income $5,000. That's 30% DTI. That means that 30% of your income goes towards debt. And in our next few slides, I'm going to show you the different loan types and the maximum DTI, debt to income, allowed for those loan types. So if you know you have a lot of debt and your income is not where you want it to be, there are some things that you can do. 1, pay down that debt. 2, increase your income. Or 3, perhaps bring on a co-signer, co-borrower for your home loan. Now, when we're talking about debt to income, the max that you can do for certain loans, when we look at conventional loans, it's governed by Fannie Mae and Freddie Mac. Fannie Mae will allow up to 50% with an automated desktop approval. That means the computer automatically approves you. It'll allow up to a 50% debt to income ratio. Freddie Mac, 45%. When we look at the FHA loan, which does not stand for first-time homebuyers, it's actually Federal Housing Administration. This loan will go up to as high as 56.9% DTI. The VA loan doesn't officially have a DTI cap in the guidelines. I have actually seen where veterans have been approved with a 50% to 70% debt to income. That's right, debt to income for the VA loan. And that's why one of the reasons why I feel like that the VA loan is one of the best loans in my opinion. VA loans are less stringent when it comes to credit requirements as well. A USDA loan, a very great loan, but they're going to max out typically at 41% debt to income. It's a great loan, but a lot of people don't qualify because they have too much debt and the homes that they're looking at are not in the USDA location. So that's something to keep in mind as well. Now, here's a biggie. A lot of people want to talk about how much money do I need, Sue? What is it? How much money do I need for closing costs, down payment? What do I need to have? And I understand you want to know what you need to have, but here's the thing. That's just like you having a problem with your car and you calling the mechanic and you're asking them to diagnose it over the phone without even seeing the vehicle. It's extremely hard. So all I can do, much like a mechanic, is just give you an idea of what you will need for down payment and closing costs. But in order for me to be able to tell you precisely, I would need an application. I would need to look at your pay stubs. I would need to look at your W-2s. I need to look at your bank statements. I need to look at your credit to be able to tell you exactly what needs to happen. So keep that in mind. So this particular webinar is not catered to just one person. I'm giving the information about what the lenders look at, but keep in mind that everyone's situation is different. I cannot stress that enough. It doesn't matter if your mother got this or your sister got that or your father got this or your best friend got this with the loan program. Everyone's situation is different because I guarantee you your credit's not the same, your income's not the same, your job stability is not the same, your retirement or savings is not the same. So because all of those things are different, every scenario will be different. But here is some money that you will need. This is just to put you in the mind frame to get ready to buy your home and to let you know what lenders are looking at. Earnest money is money that you pay when you find a home that you like and you put an offer on it and the sellers agree, you put down an earnest money deposit. And that is showing good faith that you do intend to buy this house. Typically in South Carolina, you're looking at anywhere between $500 to $2,000 that you would have to pay up front before even getting into the loan process. This is what you would do with you and your realtor. You negotiate this fee when you're putting in an offer, a contract to buy a home. The seller agrees to sell you the home. Now you begin to do your inspections. Typically, inspections range from a home inspection, a pest inspection, surveys, and things of this nature. Home inspections typically in South Carolina are anywhere between $400 to $800, depending upon the house size and the location in South Carolina. Pest inspections can range anywhere between $75 to $200. And surveys can range anywhere between $400 to $800. You don't have to have a survey, but I do recommend it so you know where your the lines of your home, where it stops, the boundaries. And then there's the appraisal. The lender will have to order an appraisal to determine the value of the home. So in the case of this, you will have to pay anywhere between $600 to $800, depending on the location of the home and depending on the size of the home. But typically in South Carolina, the amount is right around $600. Now, these are all upfront fees, okay? So typically on a low end, you would need to have at least $2,500 upfront to be able to put down your earnest money deposit, pay for your inspections and your appraisals. Then we get into down payment and closing costs. We're going to talk about the different loan types and tell you what the down payment requirement is. What I always like to tell people is factor in down payment being anywhere between 3% to 5% of the purchase price. So if you have a $100,000 house that you're buying, 3% of that is $3,000 for the down payment. And closing costs, the same thing. Factor in between 3 to 5% for closing costs. So let's just take the low number. If we did 3% for down payment and 3% for closing costs on a $100,000 house, that's 6%. That means we would need to have at least $6,000 for down payment and closing costs. That does not include the appraisal, inspection, or earnest money deposit. Okay. On the high end, if we were to take 5% down payment, 5% closing costs, that's 10%. On a $100,000 house, that would be $10,000 that we would need to bring to closing. Now, sometimes reserves is required. What is reserves? I'm glad you asked. Reserves is when, after you've taken care of your down payment, your closing costs, and the inspections and the earnest money and all that, the bank wants to see that you still have some money left over after closing, because they want to make sure that you're still going to be able to survive after you close on this home loan. So sometimes when the debt to income is really, really high, the bank may say, hey, we need to see at least one monthly payment still left in your savings or checking account. So whatever that monthly payment is for that mortgage, they may want to see that remaining in your account after you close the loan. That's what reserves is. And now we talk about the loan types. Again, FHA is the Federal Housing Administration program. Anyone can qualify as long as you meet the criteria. It is a 3.5% down payment for this home. I'm sorry, 3.5% down payment for this home. And of course, closing costs is associated with every home. Now, if you have a 500 credit score, FHA will go down to a 500 credit score, but then they require 10% of the down payment. And of course, closing costs. Again, I recommend you do not apply for a home loan with a 500 credit score for FHA. The rates will be really, really high. Then there's the conventional loan, which requires 3% down of the purchase price. Then there's the veteran home loan. And I think this is the best loan out there, not just because I'm a veteran, but I really do think it's the best loan because it really works to try to help veterans get into homes. A lot of veterans don't know that they can use it. There's no expiration on it. If you qualify, you can use it. You can also use it more than once. It's 0% down. But again, veterans, because a lot of you have come to me thinking that you don't have to pay closing costs. Closing costs is associated with every loan. Closing costs are paying. Here's what closing costs is comprised of. It's the attorney fee, it's the title fee, it's any insurance or escrow that has to be collected up front. It's the lender fee. It is the mortgage, the recording of the mortgage fee, anything that's associated with that loan that has to be done to get it to closing. An attorney has to do that title search to make sure no one else owns that home or can lay claim to it, or make sure no liens are against it. That costs for the attorney to do these things. It takes time. That costs. We put title insurance on it to ensure that no one can come back. That costs. We pay the processors to be able to do this work for us. That costs. The lender charges a fee. Underwriter has a fee. And of course, mortgage broker, our fee is in there as well. All of these fees are common when closing a home loan. This is what the closing costs are consist of. Now, moving on to the USDA loan, it is 0% down as well. Of course, when you're applying for a USDA loan, it's a great loan, really, really, really great loan, but they are limited. They have certain limitations on it as it pertains to income and as it pertains to location. And again, this is the loan with the lowest DTI requirements. You cannot exceed 41%. And of course, investor loans, for any of you that are investors, we do have those available too. Typically, we require 20% down when you are purchasing those. And of course, I'll be singing this throughout the whole webinar. Closing costs is attached with every loan. Now, here's the great thing, because I know you're probably thinking, Sue, I don't have all that kind of money. There is assistance. There's down payment assistance to help you with the down payment as well as closing costs. And if you don't qualify for down payment assistance, or you don't want it, if you have a really, really great realtor, which I know you will have one, your realtor can negotiate with the seller and ask them to pay some of the closing costs for you. Hence the reason why you may see some realtors posting that my clients didn't have to pay anything at closing. Well, that's because they either got down payment assistance or the seller contributed towards their closing costs and help with the down payment and help with the closing costs. But let me be clear. Let me tell you, when people tell you you do not need money to buy a house, that is so not true. You may not need your money, but you're going to need somebody's money, because you're going to have to put down an earnest money deposit. You're going to have to pay for inspections, and you're going to have to pay for appraisals. And if you don't have a down payment assistance program or sellers to help you, you're going to be required to put down a down payment and pay closing costs. So keep that in mind. Okay, you're probably like, okay, so you're talking my language now. Down payment assistance programs. Where do I find these bad boys? Well, you have some with the city, you have some with the county, you have some with the state. Some builders offer it. And of course, I'm a mortgage broker, so certain lenders I use, they offer down payment assistance programs. So when it comes to getting this assistance, ask your mortgage broker, which should be me, where you can find these programs and how they benefit you. I will say this: most programs, state programs, want you to have a 640 credit score. However, with the broker channel, we have down payment assistance programs that can go down to as low as a 600 credit score. And then you have some cities and counties that do not even require a credit score. It's just you may have to live in the house for a certain number of years in order for that grant or that assistance to be forgiven. But definitely go to your city websites, your county websites, your state websites. If you are buying from a builder, they have incentives. And of course, the lenders I use, they have incentives as well. So now let's do a brief recap. I told you I was going to tell you the 4 things that the lenders look for to approve you for your home loan mortgage. And you probably never had anybody break it down for you. So I wanted to do that for you so that you can be prepared, because I think that the biggest thing that people need is the information on how to be prepared financially. So you want to make sure your credit is good to go. You want to make sure your income is good to go, meaning that your debt to income is reasonable. You want to make sure that you have job stability. You've been on a job at least 2 years. You've been employed for at least 2 years. You want to make sure that you have money. You want to show money in a checking or savings account, your stocks or bonds, or a 401k or retirement account, to show that you do have money, because when we put these things into the system, it's going to require you to have money for down payment and closing costs. And if you do not have a down payment assistance program or the seller helping you with these funds, you will need to show these monies in your account to be able to close this loan. It paints you a stronger financial picture, and the lenders are more prone to say yes. But again, there is help with down payment assistance, and there's help with closing costs. So let's talk about how most buyers fit in. Most buyers are either ready right now, or they're ready in 3 to 6 months, or they need a plan. So what we're going to do is we're going to determine what pot do you fit in and how you can get ready to be ready if you're not ready right now. Category 1, if you've got strong credit and it's strong enough to move forward, and you have income and job stability, your income is documentable, right? Whether it's retirement income or whether it's disability income, as long as we can document it, or W-2 income or self-employed, that's the kind of income we want. And if you have enough cash to support your purchase, you're in category 1. You're typically ready to talk options and shop with confidence. Category 2, if you need to improve your credit just a little bit, maybe reduce some debt because your debt to income is a little high, or you don't have quite as enough cash as you desire, you might be ready in 3 to 6 months. But the truth of the matter is, sometimes, little things can shift your credit really, really fast and get you to where you need to be. Or paying down a high interest credit card, reducing that debt, that could really help out your debt to income really quick, or paying off a debt. And building cash, just saving. Maybe you came into a windfall, or maybe you got some taxes, or maybe someone gifted you some money. That could work out as well. You can use a gift, meaning someone can give you money for down payment and closing costs, but it just has to be documented. They can't just give you cash. It has to leave their account, and we have to trace it. We have to show the proof that it actually came from their account and wire it to the attorney's office. Category 3. This is not the end of your story. Just because you need to clean up a little credit, that doesn't mean that you can't make it happen. Because I can tell you this, I have helped people get on a path, provide a strategy for them, and they've done it. It may have taken them 6 months, may have taken them 8 months, but when they came back, they were ready. So if you've got some late payments, right, in the last 12 months, we want to at least let 12 months go in between that. We want to build up our savings. We want to improve our income, lessen our debt, and put ourselves in a better position. So now that I've told you what the categories are, category 1, category 2, category 3, go ahead and examine yourself and determine which category you are in. Are you ready right now? Do you need 3 to 6 months to work on some things? Or is it going to take longer than 6 months? Do you actually need a strategy plan? I want to ask you at this time, because we're coming to the end of the webinar, I still got a couple important things to share with you, but I just want to check in with you real quick and just ask, did I deliver on my promise for this webinar? Now, when I ask, did I deliver on my promise? I'm asking, do you now know the 4 areas lenders use to evaluate a mortgage application? You should. I hope so. Do you know whether buying right now or waiting 6 months is realistic for you? Do you feel like you know where you are? Are you in a better position to ascertain if you're ready now, or if you need to wait, or if you need to put some things in place so that you can be ready in a year? And do you feel more prepared to buy a home than you did 30 minutes ago? I am hoping that the answer to all of this is yes. If it's not, the great thing is that this is recorded. You can go back and watch it again, and I guarantee you should have that understanding. But if you don't, I'm going to tell you how you can get in contact with me so we can discuss your situation one-on-one. So I want to say this, though. Here's what you should have if you're ready to move forward. If your credit is around a 620 or higher, you have stable income, you have on-time payment history for the last 12 months, and you have some money saved, good news. You are closer than you think. You are in an amazing position to fill out an application, apply for a home loan, and get approved. 620 credit score or higher, stable income, on-time payment history for the last 12 months, and some money saved. If that's you, here's the next step. Complete my loan application. Now, when you complete my loan application, there is no guessing. I'm giving you a real answer. I'm going to review your credit, your income, and your debts. I'm going to tell you exactly what you qualify for. And if you're not ready to be pre-approved, I'm going to give you a plan to tell you what it takes to be pre-approved. It's no more guessing. It's actually putting you in a position to buy your home this year. If you're not ready to take the application, you say, I don't know, Sue, I'm just not ready to take the application yet. I understand. Simply go to my website, loanswithsueham.com, and take a 60-second mortgage ready quiz. I don't pull any credit or do anything of that nature. I just ask you a few questions. You answer them honestly, and then I'll tell you exactly where you stand. It's very easy, very insightful, very quick. Probably take many of you less than 60 seconds. However, if you are ready to apply for the application, you can go to that same website, loanswithsueham.com. I'm here to tell you that I'm ready to help you make home ownership your reality. Buying a home doesn't have to be as challenging as everyone makes it out to be. If you know the 4 things that the lenders look for and you put yourself in position to achieve those 4 things, then you can move forward buying a home really quickly, anywhere from 21 to 30 days on average, at least with me as a mortgage broker. That's what we're doing, getting people into homes within 21 to 30 days. We move quickly. And as a mortgage broker, oftentimes our rates are cheaper. We definitely move quicker. And we are accessible. I think that's one of the biggest things that people say about me is that the fact that I am available and I communicate things clearly and I let you know what's going on. I explain the fees and I am very transparent. I'm also there to tell you, hey, this is not going to work. I'll let you know. And I'll say, but this is how we can make it work. So I don't just say no. I give you a plan. I give you a strategy with the hopes that you'll return so that we can solidify the deal on you becoming a homeowner. Unlike a lot of people, they don't even return your calls. They don't even tell you how to move forward. That is not me. So I want to extend the invite again to you guys. Let's go ahead and back this up so you'll have the, let's see, the website. Oops, sorry about that. The website where you can actually fill out your application, because that would be your next step. There we go. And if you just want to take the 60-second mortgage quiz, you can do so as well on the same website, loanswithsueham.com. So I hope you have found this information very beneficial. It has been my pleasure to share this with you. Let's make this a little bit bigger so that you can see it. It has been my pleasure to share this with you. I look forward to helping you buy your home this year. If you have any questions, take the quiz, and you can also set up a free consultation with me at loanswithsueham.com after you have taken the 60-second mortgage ready quiz.